to use a well-regulated product. And I think another important point here is Novi is our customer. That's a subsidiary of Facebook Meta. But Novi itself is a regulated money services business. They are regulated to operate in almost all states in the United States. And we have done extensive due diligence on their controls and the regulatory oversight that they have. And we feel very confident that they're following those. And so in terms of the Novi usage of our product, it's just like anybody else, just like if they had a bank account, which they do, and they were using. And so in that way, the services they're getting from us are no different than services they get from any other financial institution that they have a relationship with.
And so this is supposedly a pilot that's limited to a number of users in Guatemala and the U.S. What is stopping Facebook, again, from in the future allowing its nearly 3 billion monthly active users to make payments and save funds with a packed dollar or other privately issued stablecoin through a Nova wallet? How long is this pilot? Can you describe it?
Yes, the pilot's limited and controlled. It's something that we work together with our regulator on, and they have reviewed our program. Novi would be best position to talk about their plans to expand it. But right now, they're in a pilot phase. It's just the U.S. and Guatemala. It's quite limited in scope and size.
I now recognize the gentleman from North Carolina, Mr. McHenry.
Well, thank you.
Who is a ranking member of the committee. You are now recognized for 5 minutes.
Thank you. Mr. Brooks, let's step back from digital assets and blockchain for a moment. Let's talk about where the internet was, where it's come to, where it's going, right? We're trying to level set here for policymakers. So originally, the internet was a read-only format, in essence. We're consuming information. And then there's additional layers that we place on. It became much more interactive. But counterintuitively, much more interactive, but much more centralized in Web 1, Web 2. What we're hearing now is Web 3. Policymakers need to understand the nature of Web 3. This is a hearing about a component of Web 3. Now, along those lines, what are the characteristics that defined Web 1 and Web 2?
Mr. McHenry, thank you very much for that question. I think that's critical to understanding what we're all trying to build here. So the characteristic of Web 1, if people remember their original AOL account, was an ability to look in a curated walled garden at a set of content that was not interactive but was presented to you on AOL the way that Time magazine used to show you the articles they wanted you to see inside of their magazine. Just you could see it on a screen. The innovation of Web 2 was that suddenly you could not only read content, but you could also write content. This is when the blogosphere became a big thing. People remember this from the late 90s, the early 2000s. The reason for the centralization of the internet, of course, was that all of that activity was being monetized by a very small number of companies. Facebook, as the chairwoman mentions, Google, and 2 or 3 other companies. What makes Web 3 different is the ability to own the actual network. And that's what crypto assets themselves represent, is an ownership stake in an underlying network. So when you hear people talk about, for example, layer 1 tokens, what they mean is this is your reward for providing the ledger maintenance services, the computing power to the network that on Web 1 and 2 was done by Google, right? So now people in my hometown of Pueblo, Colorado can actually own the Ethereum network, but they can't own the internet. That's owned by Google and a few other companies. That's what the project of crypto is all about, is allowing people to directly own the networks that have native assets that are supporting it, and that's the nature of decentralization, where the token holders are the people who control the asset, not
so
Google.
Token holders, for our language here on the Hill, those are digital assets, right? Which are the keys to open up the ledger for you to participate, right?
Correct.
So describe to us how those digital assets fit into this internet revolution, Web 3.
So the concept is that you have sort of application layer tokens and you have protocol layer tokens. So if I'm an owner of Bitcoin, let's say that I'm a miner of Bitcoin, somebody who actually creates Bitcoin. The Bitcoin is the reward I receive for doing the work to keep the network operational, and that allows me to own a piece of the Bitcoin blockchain. Or take Ethereum, which is easier to understand. The Ether token represents an ownership stake in the network, but on top of that network are all kinds of apps that get built on the network, much like the apps on your phone depend on the underlying network existing that lets the phone operate. And so people will make judgments about which network is likely to win, and they will invest in the tokens in that network much the same way you might invest in Google stock because you think Google is going to scale access to the original internet. The difference being here, you can vote on what happens in the future of a proof of stake network, for example. You can get rewarded through a proof of work token for maintaining a ledger on something like Bitcoin. But the real message here is that what happens on the decentralized internet is decided by the investors, versus what happens on the main internet is decided by Twitter, Facebook, Google, and a small number of other companies.
Okay, so getting this layer on digital assets right, for Congress to understand this, everything is built upon that on-ramp to this new internet. So very important for us to be sensitive to how this develops and any actions we take in terms of laws and updating laws to incorporate these new technologies.
Yeah, Mr. McHenry, couldn't agree more, and I think when you hear about all of the problems of different big tech companies, the importance of an owner-controlled network becomes clear.
Okay, owner-controlled network rather than a cooperative, right? And
Yes.
thinking in those terms.
Absolutely.
Right? So if you're not a part of management, you're not making a decision in Web 2. If you are a participant in the network, you're cooperating in the making of those decisions.
Exactly right.
Okay. So I ask this not to be insulting to the panel, but to have a level set here so we have an understanding of what we're talking about. This is not simply about you on this panel. It is about trillions of dollars of assets that did not exist before Satoshi wrote his white paper 13 years ago. It's about $3 trillion in notional value at this stage around the development of a whole new range, a whole new suite of technology that will be developed across the globe, whether or not the United States embraces it and wants to compete, or if it's pushed offshore. So as policymakers, we need to understand what we're talking about here. This is a small panel, important as you may be, a small panel about the discussion about Web 3. And so with that, Madam Chair, thank you for having this hearing, and I hope that we can have more understanding by policymakers about these important concepts. Thank you, Mr. Brooks.
Thank you very much. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Thank you, Chair Waters, for having today's hearing. Our financial system has been built up over time with us learning from each financial crisis, fixing and adjusting as new financial risks come forward. From the Great Depression and the creation of the FDIC and deposit insurance to the Dodd-Frank reforms after the 2008 financial crisis, we may not all agree on every aspect of those laws, but they've made our financial system and our entire economy more resilient and consumers and investors more protected when things do go wrong. In 2018, the New York Attorney General released a report from its Virtual Markets Integrity Initiative, which detailed a few key findings regarding crypto trading platforms on potential conflicts of risk and interest, lack of serious efforts to stop abusive trading activity, and limited protections for customer funds. The report stated, and I quote, "Customers are highly exposed in the event of a hack or unauthorized withdrawal. While domestic or foreign deposit insurance may compensate customers for certain losses of stolen or misappropriate fiat currency, no similar compensation is available for virtual currency losses." This is not a theoretical concern. In fact, Coinbase was reportedly the subject of a hack earlier this year, impacting at least 6,000 Coinbase customers. Ms. Haas, what happens today for a Coinbase customer in the event of a hack of Coinbase or a Coinbase wallet, or in the event of unauthorized withdrawal? What protections does a customer currently have? FDI insurance, commercial insurance, could you answer that question, please? Thank you.
Yes, thank you so much for the question. So Coinbase does secure 12% of the world's crypto, as I shared with you earlier, and we have extensive controls to protect our customer assets. We bifurcate our assets into two different storage systems. We call one the hot wallet, and we call one cold storage. And less than 2% of our assets are held in a hot wallet, which is subject of a cyber attack. Specifically, the incident you mentioned was not a hack of the Coinbase systems, but in that event where customers did lose funds due to other losses, we did reimburse customers for that event. We do protect our customers for any hack of the Coinbase hot wallet, and we have third-party insurance, plus we use our own balance sheet to protect our customers for the event of loss on our platform.
Please pull the microphone closer to you and speak into it so all members can hear you.
Thank you so much for the clarification. With regards to what losses we typically see, though, in the press, we typically see these are account takeovers at the end point where a customer has lost their credentials and then has had a hack of their own phone, their own personal device. And that is unfortunate at this point in time because that loss is not well protected for within the broader crypto economy. That is something that Coinbase continues to study and would look to, over time, do more to support our users for those losses.
Reclaiming my time's very limited. Is that uniform, the protections you talked about for all crypto exchanges and wallets, or just for yours?
I'm speaking specifically about the Coinbase protections we offer.
Okay, so it's not available to others. So do you think customers could benefit from some uniformity and standardized minimum protections if and when customers lose their funds through no fault of their own?
I do believe there's opportunity there.
Richie? In addition to this committee, I have the honor of chairing the Oversight Committee, and we recently held a hearing on the rise of ransomware and strategies for disrupting criminal hackers. As detailed by a recent FinCEN report, $590 million in suspected ransomware payments were reported by financial institutions in the first 6 months of 2021, and it's getting worse. So it's no surprise to me that these criminals frequently seek payment for ransomware attacks through cryptocurrencies. And FinCEN identified several money laundering typologies for these actors. Ms. Dallaire and Ms. Haas, our anti-money laundering requirements are paramount to prevent fraud, sanctions, invasions, and the financing of terrorism. And you and your companies have highlighted your firm's compliance programs, stating that these standards are important to protect the financial system and to drive trust and adoption. But not everyone in this industry believes that, and many have rejected or avoided compliance standards. Some actively promote themselves on not complying with Know Your Customer requirements. This is an entire financial services ecosystem, and one weak link exposes the entire system to money laundering risks, as highlighted by the FinCEN data I just mentioned. Could you share why your firms have taken your anti-money laundering compliance approach and the benefits of doing so across your firm's products and services? And what steps can we take to bolster our anti-money laundering efforts and ensure all crypto marketplaces comply?
The gentlewoman's time has expired. The gentlewoman from Missouri, Ms. Wagner, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. Ms. Haas, let's continue. SEC Chairman Gensler has indicated on multiple occasions that, and I quote, "The test to determine whether a crypto asset is a security is clear." However, Commissioners Peirce and Roisman noted that they believe there to be an obvious lack of clarity for market participants around the application of securities laws to digital assets and their trading. The lack of clarity is clear through the numerous requests that the SEC receives for these no-action letters. In your view, is additional guidance defining clear rules of the road for investors and market participants needed at this time?
Thank you for the question. We believe this is a very important area of focus for the SEC and this committee. We do agree that the laws are clear. However, existing laws, regulation, and legal precedent make it clear that blockchain tokens are not securities. So we believe that the law clearly shows that blockchain-based digital assets are one of two things: either a new form of digital property or a new way to record ownership, as Brian Brooks spoke earlier about. We do believe that clarity is needed because these are new assets. It's a new way of transacting with these new protocols that we spoke about, and I think it would benefit all of us in the ecosystem to have agreed upon definitions.
I couldn't agree more, and I would hope that Chairman Gensler would be listening to his commissioners and some of the feedback that you all are giving him. You know, we talk a lot about financial inclusion in this committee, and digital assets have the potential to provide fair access to financial services to all Americans, and I believe that Mr. Bankman-Fried brought that up, and many of you did in your written testimony. I'd like to start, and I've got limited time, with Ms. Dixon, and then I think Mr. Allaire. How would digital assets and blockchain technology facilitate financial institutions or financial inclusion and benefit the 1.7 billion unbanked people throughout the world, and particularly the millions here in the U.S.? Ms. Dixon.
Thank you for the question. This is a really important area. Understanding your time is limited, I'll just say that blockchain allows value and money to flow just like email. So it's very simple in terms of how it can get from one point to another, and it does so very, very quickly. The importance of that is it actually can cross borders much more simply than anything else that's out there today. So the value of blockchain is the ability to send from the United States, for example, and send to another country without having to reconcile with all the different software and intermediaries that exist today. So it eliminates intermediaries, it creates less friction in the marketplace, and it allows users who don't have bank accounts today or who choose not to get bank accounts or have been de-risked by banks from being able to be able to access this technology very cleanly because they can do so with a wallet.
Thank you very, very much for that input. And Mr. Allaire.
Thank you, Congresswoman. I think financial inclusion is a critical design goal for many of us, and certainly as we think about USDC, you know, today USDC as a payment technology for dollars on the internet enables users to transfer dollars in a fraction of a second with a transaction cost that can be as low as a 1/20th of a penny, and with the throughput of the Visa network. That's a benefit that can be brought to individuals, and I'd like to really emphasize something for the committee, which is one of the most powerful things about this technology is that it is the open internet. Just like anyone can have an email account or a text message or access the internet, this is an open financial system, and when you combine those kinds of access efficiency and that openness, it creates an opportunity for anyone with a mobile device anywhere in the world to seamlessly exchange value with one another.
Great, thank you. Mr. Brooks, in your
Open financial system, and when you combine those kinds of access efficiency and that openness, it creates an opportunity for anyone with a mobile device anywhere in the world to seamlessly exchange value with one another.
Great, thank you. Mr. Brooks, in your
open financial system, and when you combine those kinds of access efficiency and that openness, it creates an opportunity for anyone with a mobile device anywhere in the world to seamlessly exchange value with one another.
Great, thank you. Mr. Brooks, in your
open financial system, and when you combine those kinds of access efficiency and that openness, it creates an opportunity for anyone with a mobile device anywhere in the world to seamlessly exchange value with one another.
Great, thank you. Mr. Brooks, in your
Open financial system. And when you combine those kinds of access efficiency and that openness, it creates an opportunity for anyone with a mobile device anywhere in the world to seamlessly exchange value with one another.
Great, thank you. Mr. Brooks, in your